Initial investment of $5,000. Monthly contributions of $200. Continue this for 10 years with expected minimum 10% annual returns. Guess what? You will end up with $53,866.85 in your bank account. Ever wondered why in the world of investing, the phrase compound interest is regarded as the most powerful force? It is because these two extremely powerful statements are fundamentally the secret to making successful investments and being wealthy. In fact, going by historical precedents, creating generational wealth and becoming financially free is largely a function of making more money. And the smartest way to accomplish this is by adopting and understanding how compounding works. In this video, we go over how to carefully apply the concepts of compound interest to make your money work for you and lead you to riches. So, let's begin. The idea of compound interest is the most powerful force in the universe, according to Albert Einstein, the most well-known physicist in the world. The world's most successful inventor, Warren Buffett, once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Compound interest is regarded as the eighth wonder of the world by investors everywhere because it only works with time and has a uniform impact on everyone. While many people have held the long-held belief that simply increasing their savings will allow them to become wealthy and achieve some degree of financial freedom, ever since, the world has changed. And the best way to build money in the present world has been through investments and earning through compound interest. Compound interest means that in addition to receiving interest on the principal amount of your investment, you also receive significant returns on your interest, which are often returned back to your principal to provide you the opportunity to receive more returns. This is the only most important component of compound interest right now. The fact that the interest you earn is subtracted from your principal at various times, including daily, monthly, yearly, and even continuously. The trick here is that the more often the income you earn on your investment is compounded, your principal balance will grow more rapidly and you will get richer over time. Assume for the purposes of this discussion that you invested $5,000 at a 5% yearly interest rate. By the end of the first year, you would have accumulated $250 in interest, which when added to the initial balance increases the investment's worth to $5,250. In the second year, you would receive 5% or $262.50 on your larger balance of $5,250, which in turn, increases your new principal balance at the end of the year to $5,512.50. However, what happens if you continue to leave this investment untouched for 10 years? Here is when compound interest's power is brought to use. By the end of the 10th year, you would have an investment balance of $8,235.50. By putting your money to work for you over a 10-year investing cycle, you may have earned $3,235.50 in compound interest. One fundamental idea that the extremely wealthy who have a lot of money but do not appear to work for it comprehend and use to increase their wealth is compound interest. If you do not fully comprehend the important details and the various elements that go into producing those high returns, your understanding of the concept of compound interest will still fall short. These fundamental variables fall into 5 main categories. Number 1. Your starting principal. Without a doubt, compound interest builds up over time. However, the amount of returns you would earn at the end of your investment cycle would still primarily depend on how much you had invested as a principal amount. If you can't afford to put down a large sum of money right now, you would be in for a surprise when this first investment starts to grow exponentially. If not, you can still benefit from compound interest with whatever small initial principal you have available to you. Number 2. Frequency of compounding. This is just as important to having the ability to make a sizable initial investment. The other important factor affecting how quickly your principal balance increases, the rate at which interest is compounded. There are alternative ways as well, but annual compounding is the most reliable and preferred. Therefore, it is essential that you understand fully how frequently you would be earning compounds. More frequent, the better returns. Number 3. Interest. Would not it be foolish if you do not understand fully how the interest you are getting on your investment is getting calculated? Naturally, you make more money when the interest rate is high, but when you take out a loan, the same thing holds true. In this situation, the higher the interest rate, the more money you would owe to the bank. Number 4. Duration of investment. Compound interest only works its magic when you leave it untouched for a long period of time, ideally between 10 and 30 years or longer. your chances of multiplying your initial investment increases by many folds, as long as your money stays untouched. So, make sure to not touch your investment for a significant amount of time. Number 5. Frequency of deposits and withdrawals. These occur often over many investing cycles and, in turn, have an impact on the returns you finally receive on your investments. The rate at which you add to or deduct from your principal balance and make a major difference in the long run. In the digital world that we live in today, it's now very easy to calculate the potential returns from an investment. When interest is compounded over a specific period, you may simply escape the arithmetic by using any of these readily available online calculators to do this. But while doing the math, it is crucial to divide the interest rate by the number of times it will be compounded over the course of the investment years. Your interest rate can be an average over a day, a month, or an entire year, depending on how often it is compounded. As a result, it is crucial to comprehend and be knowledgeable about how to make compound interest work for you once you have a complete understanding of all the variables that affect compound interest. To succeed at this, it is crucial to be patient and give oneself time. Compound interest is a situation where time ultimately decides. The general rule of thumb is to begin saving for retirement as soon as you can. This is due to the fact that you can afford to develop your investment for a longer period of time if you start sooner. Starting early allows you to build the majority of your retirement savings through compounding and may even allow you to retire early. Understanding how to use compound interest to your advantage is a fantastic equalizer. There is no upper limit to the amount of wealth you can accumulate through compound interest, regardless of your background. No matter who you are or where you're from, you can always take advantage of compound interest. Earning with compound interest can be challenging in the beginning, especially if your returns are still in the form of small snowballs, as is typically with many investments. However, if you leave your investment untouched, these early snowballs could quickly turn into an avalanche. This is essentially what wealth development implies, and compound interest will not start working in your favor and your money will not start at naturally attracting new wealth unless your investment returns snowball into an avalanche. Compound interest is undoubtedly a fantastic road you may take to grow wealthy and achieve financial freedom as an average earner. While many people still cling to the false notion that they lack the resources to profit from the stock market, they actually do not need that much. It is the cold, hard fact. To put things into perspective, the average income in the United States is currently $50,000 per year. If you are 25 and making $50,000 a year, all you really need to do is put $5,000 of that money into the stock market each year and hope for at least a 10% return. By the time you reach retirement age at 65, every $5,000 you invested would have accumulated over the course of 40 years to equal $2,434,221. Only compounding interest will make this possible, and if you are fortunate enough to locate a terrific investment with a high return, your compounded profits will be significantly higher. You may be sure that nothing can stop your investment from increasing and that you will continue to profit every minute of the day. Compound interest tests your patience, but may also be your best friend and the surest path to wealth, particularly if you can maintain consistency. Get involved today by discarding all of your false assumptions about compound interest. You might already be an early retiree and the newest millionaire in town in 1 or 2 decades. Compound interest should pay off for you if you are persistent and disciplined. Let us know in the comments section what some of your best stock market investments are and for how long you've been holding them. Also, video popping up may interest you to get more tips on personal finance. Make sure to watch that video too.